start paying for long-term care, as most of you know, this gets extremely expensive. Even in home health care, if you go into assisted living and full-time nursing care, we're looking at substantial outlays for medical expenses, and that is all deductible. These are all deductible medical insurances, all deductible medical expenses. They are limited though by certain floors, and by in many cases they may not be worth it to people if they're under $10,000 or so after you go through all the reductions related to it. Another very expensive medical deduction that people can qualify for in later years is if there are any kind of medically related housing modifications. This can be a substantial amount of money, and it's one that you're going to have to document properly on the tax return if you're going to try and get it. Basically, what you have to do if you're putting in a wing or a floor to take care of a loved one or something like that, that can be you can spend $50, $100, $150,000 doing something like that, and it's up to you to document what is the amount that's deductible. And the way you do that is that you have to use professional appraisers. You need to get an appraisal, before and after appraisal is what it's called in the business. I mean, ideally, you would get the appraisal done before you had the work done, and then you would have an appraisal done after the work is done. The reality is, a lot of times people don't do that. They hire an appraiser to come in and give them a before and after. And the IRS pretty much relies on the appraising profession to do this in the right way. And and what's interesting about this area is that what they're going to come in and appraise, and what you can't deduct, is any addition to the value of the house. If you get this thing done, if you spend $100,000 and a guy comes in and gives you an appraisal and says, well, you've just added $100,000 to the value of the house, then you don't have a medical deduction. That's generally not the case. Most of the times, these modifications that we go through have very little effect on the value of the house. So that if you get an appraiser to say, well, yeah, we spent $150,000, but it's really only worth, in terms of increasing the value of the house, and it really only took it up $20,000, that difference, $130,000, is a medical expense. And that's that can be a significant amount for somebody who finds themselves in the latter stages, or finds themselves taking care of someone in the final stages of their life. So it's these numbers can get big, and when they do, that's a rare situation. And when you do have something like this, I would urge you to get a tax professional involved, particularly in the realm of long-term care. Just for instance, a circumstance that I run into all the time is with clients. As they're getting older, they move into continuing care community, which may start off in independent living, move into assisted living, and then finally into full nursing care at the end of the life. What we essentially do as tax professionals is rely upon the institution providing the care to provide us with a letter identifying how much is of all the money that you spent with them, which could be $100,000 for somebody. How much of that is available as a medical deduction? And you'll find out even in places with independent living, a certain percentage is going to be deductible. As you move, if you move into any kind of assisted living, a significantly larger portion of it is going to be deductible. And depending on the arrangements that you've made to go into such a community, a portion of your entry fee will be deductible, and you can rely again on the institution to document how much of that is deductible. And it's certainly, they're trying to make you happy. So they're looking to turn over any deduction that's possible for you. And it's the document, the kind of documentation that the IRS lives for. They live, they're very happy to see documentation from appraisers, and they're happy to see documentation from these continuing care communities to establish a basis for the write-off. In both of those instances, though, when you find yourself in that kind of situation, I really would say that that's a time to bring in a tax professional to help you to make sure that you're getting all the deductions that you can. So basically, when we're in a situation where we have large medical expenditures, either housing modifications or long-term care, or a medical condition that insurance is not reimbursing everything for, something like that. That's one situation. But those are really kind of the extraordinary situations. Like I say, you should bring in a tax professional at that point. Most people, though, find themselves in a situation, not everybody, but when you're in your retirement years, and say you've just retired, you might have some medical expenses. You've got premiums, but if you get on Medicare, those premiums are going to go down. Unfortunately, though, this last few years before you get on Medicare, your medical premiums could be substantial. But when you get into the medical expenses, for most people, the prescriptions, the doctors, the dentists, the hospitals, the clinics, all of these expenses are going to be reimbursed largely by medical insurance and by by health savings account or flexible spending accounts if you've been lucky enough to participate in those. Any kind of reimbursement that you get from an insurance company or an HSA or an FSA has to reduce. So your deduction is really only that net out of pocket that you're paying for medical expenses. Then on itemized deduction, you're further limited. You have to take 7.5% of your adjusted gross income, and that creates a floor on that. So you've whittled everything down to your net expenses, and then you've taken this 7.5% haircut on all the adjusted gross income that you've made. And so now your medical expenses are for a lot of people, for a majority of people, are going to be below $10,000. Now the reality is with most people, as they're entering retirement, they have a standard deduction, which gives them, instead of itemized deductions, you don't have to go through and itemize everything. You can just take a standard deduction for $27,000 for a married couple. And a lot of people are not going to get to a position where they have medical expenses that are going to count. I mean, you have essentially itemized deductions. You've got taxes, you've got medical, and you've got charitable contributions, generally speaking. And so, you know, your taxes are limited. Your tax deductions for income taxes that you pay during the year and real estate taxes that you pay if you own a home are limited to $10,000. So for a lot of people, they're looking to come up with $17,000 worth of deductions from their medical expenses and their charities, and they're not going to get there. So they're just going to take the standard deduction. Okay. But a lot of people that are taking that standard deduction don't know of the following rules that we're going to look at here. And that is, what happens when you're self-employed? And the reality with retirement these days, as somebody who plans retirement for people all the time, one of the best things that you can do in early retirement is to work, is to make some additional money. Now, particularly if you're in a situation where you've developed an expertise in a certain area, and I've had a number of clients that have done this, that work for large corporations for a year, their institutional knowledge is so highly valued by whoever they've been working for the last 25 or 30 years that they might hire them as a consultant. That goes on quite a bit. You know, wealthier clients I see quite often get into situations where they become compensated as board members. Even if you're, you know, not in a nice situation like that, you might want to consider keeping working. You know, I've had a number of retirees that have become Uber drivers and other types of work, part-time work situations. And as long as you're getting paid, not on a W-2, but if you're getting paid on a 1099, what we used to call 1099 miscellaneouses, now it's either, it could be on a 1099 miscellaneous or other name. Most of them are coming now, it's called a 1099 NEC, which is non-employee compensation. And if you're getting money via a 1099, then you can still take the standard deduction, but you can still look at all of your insurance premiums that you're paying, and those premiums can be taken as a deduction on the front of the tax return. It's actually called an adjustment, and this can be worth a lot of money to you. This includes, so say somebody is recently retired, they're working, they're making you know, $20,000 or $30,000 worth of income on a Form 1099. Well, against that $20,000, they can take their insurance premiums, anybody else that's in the family, their insurance premiums, and particularly if you've got a spouse that's 3 or 5 years younger than you, you're paying those heavy insurance premiums that we all have to pay when we're in our 60s before Medicare. That entire amount can be taken as an adjustment on the front of your tax return. Anything for, and that's, you know, that includes if you or your spouse are taking long-term, you know, paying long-term care insurance premiums, your Medicare deduction, your Medicare payments that are deducted from your Social Security can go on the front here as an expense. So people can find all of a sudden that they're taking their standard deduction, but they're also taking $5,000, $6,000, $10,000 worth of premiums as a reduction on the front of their tax return at the same time. All of the other medical expenses then would flow through to Schedule A, but those premiums, you can cherry pick those premiums and put on Schedule 1. It's called a Schedule 1 adjustment, and that reduces your taxable income, and that can be quite a nice windfall for you. Now, for those that have a Schedule A, or if you're in the self-employment situation, you'll want to cull off all of the health insurance premiums that you're paying and use that as an adjustment to your Form 1099 income. But then anything's left after that goes to Schedule A. And then the thing about the expenses that you can put on Schedule A is that you can also put the expenses for qualifying relatives. Obviously, dependents go on there. They go on the hospital insurance premiums for a dependent, go on the front of the return. But medical expenses for all dependents go on Schedule A along with your and your spouse's medical expenses. And other qualifying relatives, if you are supporting them, and they don't have to live with you, but if you can pass the support test on them and you are paying some of their medical expense bills, you can take those medical expenses on your Schedule A. So if you are paying for a parent's long-term care, this can go on your Schedule A if you do some proper planning about it. And this can be, a tremendous situation, because the, as I mentioned before, and I'll hit these bullet points right now again. Yeah, you must reduce for insurance reimbursement and account distributions, same way we were discussing before. But if you're flowing through mom's long-term care expenses, or you're flowing through a substantial housing modification that qualifies as a medical expense, this can be a tremendous benefit for you. The problem that I see with a lot of people, and it happens, more times than not, is the final tax return and the last couple tax return for people that find their way onto long-term care ends up creating wasted tax deductions. They file a tax return and their income is, say they die in March and their income is, 1/4 of the year, and maybe it's, $5,000 or $7,000, and they got, $30,000 or $60,000 worth of medical expenses that just don't go to use by anybody. They just die with the patient, unfortunately. So this is an area that's, has possibilities, but it really depends upon situations. It should, there are a myriad of factors to be considered in this situation. If the person that is that needs care has a lot of money, there's a lot of planning that needs to go into these types of situations. And there's more than, you need to get somebody else involved, more than just an accountant. You would need to get an elder law person probably involved in that situation. But there's there's a lot of tax benefits that can be realized with some planning in these situations. Now, there are also some tax credits. There are child tax credits, and there's credits for other dependents, which are really not that significant. And then there's also child and dependent care credit. This is payments that you make for daycare and things like that. There's also earned income tax credit, which is a situation where we have these concerns about significant medical expenses, and we have very little earned income for people. That's an area that I would just like to make you aware of, and tell you that if you're in a situation where you have low income and you do have dependents, and you do have significant medical expenses, you may want to look into the earned income credit. The child tax credits, I want to bring these up because this is an area that's going to cause a lot of consternation this tax filing season. And I'll explain to you the situation. The problem is these credits were expanded last year, mainly out of pandemic and and resuscitating the economy concerns. These credits were significantly expanded for both child tax credits and for child and dependent care credits. I just finished a tax return. We're early in the tax season. People who get their taxes done right away are usually just W-2 employees, and I happen to have one that we got done just this week, and it's a difficult situation for him because he's got a couple of young kids, and last year he had he had 2 kids under 5. One was under 4, which I believe qualified him. So he got 2 child tax credits, one for $3,000 for the older child and $3,600 for the newborn. And that was $6,600. Plus he got $4,000 in child and dependent care credit. So he got a total of $10,600 in credits. This is we're talking about a guy that makes like $94,000 as a carpenter, but he's got a young family, and we all know all of the expenses involved with the young family, and he's a single parent, and so he got this refund last year. He's got basically slightly modified position in that one of his kids went into kindergarten, so that cut down on the he could only get a dependent care credit on one of the kids, because when you're paying for school, that doesn't qualify for the dependent care credit, but preschool and after school does, along with any kind of daycare person that you hire, as long as the kid's under 13. But he was in a situation where now he was just paying for kindergarten for one, and then he had dependent care credit for the other. But because the limitations had been reestablished from several years ago, he only got 20% of the $3,000 he spent on the one kid. So he got $600 on that, and he got 2 $2,000 credits. Last year he got $6,600. This year he got $4,000. So he lost $2,600 in child tax credits, and he lost $3,400 in dependent care credits. So he went from getting a refund of $10,600 related to these items that went down to $4,600. That's $6,000 for somebody, who's got a young family and earning $94,000, and then all of a sudden they notice that they've got $6,000 less than they did last year when they did their taxes. It's painful, and that's going to happen to a lot of people with young families. This tax filing system, and for those older folks who are on the call, it's going to affect the kids. Our kids that have kids are going to suddenly find out that their refunds are a lot less because these pandemic-related enhancements to these tax credits that were available for the 2021 filing system are not going to be available for the 2022 filing system. So the now I want to kind of focus in on who are dependents and who are qualifying relatives that are not dependents, because this is a confusing area. And remember, dependents we can use for that self-employed health insurance thing. Dependents we can take all of their medical expenses, and dependents can give us an opportunity to get a child tax credit or an other dependent care credit. They also, in a situation where you're a single parent and you've got a dependent, you can qualify as a head of household and get a significant break in the tax rates that you pay. You get a higher standard deduction when you're a head of household as opposed to a single person, and your tax rates climb up the scale at a slower pace than they do for a single parent. So it's to have dependents is important for your tax compliance and for your tax planning. Children, to claim a child, it must be related to you, but there's no biological parent requirement. In other words, you know, you can adopt it certainly, but they must be related to you. And when we say related, that means linear, i.e., parents through offspring is what we call in the tax business linear descendants, plus siblings. So anybody that's related to you qualifies as a child up to age 19. From ages 19 to 24, they must be a full-time student to be claimed as a dependent. Now, in any adult that lives with you can be claimed as a dependent, but they've got to meet they've got to meet a residency test. They can't make more than $4,400 in gross income. And you have to provide 50% of their support for them to be a dependent of you. Now, so, that's a pretty high hurdle, but that's, you want to claim as many dependents as you can because that gives you help with your tax deductions. But this other area that really can be helpful is a qualifying relative can be included on your medical deductions, your Schedule A, for long-term care, housing, all of that stuff, any kind of medical expenses. They, however, do not have to meet that $4,400 gross income requirement that everybody else has to make. If they're vertically related to you or your siblings, then they can go, their medical expenses can go on your tax return as long as you provide 50% of their support. And if, in the situations that we're discussing when you're taking care of long-term care or you're taking care of, or you're bringing them in your house and you're doing an improvement to the house that is medically necessary, these generally can end up on your Schedule A and be deductible to you, the caregiver. And this is, anybody unrelated can go on that Schedule A of yours if they live with you for 6 months and they meet the $4,400, less than $4,400, and the 50% rule. That, because of Social Security, that is a pretty high barrier of entry, because you do count their Social Security as not coming from you. But if you're in a situation where you're paying long-term care and the long-term care is more than Social Security and that's all the person is making, then they can, if they're a qualifying relative, they don't have to live with you. If they're not a qualifying relative, but they're anyone else that's legally living with you for 6 months, they can qualify. So you need the dependency to claim credits. You can claim medical deductions on a qualifying relative that meets certain tests. And that's probably what I want you to take away more than anything. I do want to talk about a couple of situations, and that's if you are paying someone to be a caregiver for yourself or for somebody that you're taking care of. If you want to claim those expenses, you're either going to have to pay them via a 1099 or a W-2, or you're going to have to pay by invoice to an agency that provides that kind of service. And that's why it's usually beneficial to get those arrangements with a known home health care provider or something like that, because that makes life a lot easier. If you're going to pay somebody directly, and there are opportunities to pay relatives and out of work relatives, you can pay them either by 1099 or by W-2. The problem is that the IRS really wants you to pay them by W-2 rather than 1099. For them to qualify for a 1099, they would probably have to do the same thing for some other people. If they are doing home health care for somebody else, then you can probably get away with doing it. But if you are the person, or your loved one is the only person that's getting care provided by this person, then you have an element of control over this person that will require you to cut a W-2. And in Maryland, it's not the way it is in every state, but in Maryland, that I think is problematic. It's not so problematic for the federal W-2 and your federal withholding, because you can include what you're paying somebody on a Schedule H of your own Form 1040 and just make all your withholding payments at the end of the year. However, in the state of Maryland, you can't do that with either your Maryland withholding or state unemployment. You have to do that on a quarterly basis. So, I've had a number of clients that started out doing this W-2 thing, and then they finally gave it up because they were not making quarterly payments to Maryland and to the Maryland Unemployment Insurance Fund. And so it became an administrative nightmare to have a W-2 employee. So if you are paying for caregiving, the easiest approach is to get an agency involved that is going to bill you, and you can deduct those bills. You know, they may want you to provide them with a 1099. They may not, depending on their situation. If they're incorporated, you do not have to issue a 1099 to them. You can just pay their bills and then put it on as long-term care expenses on your tax return. So it's a lot easier. So the I know that there's you know, there are a lot of other areas that we can get into in terms of head of household and things like that, and the whole world of Medicaid planning and things like that. That, you know, we're not touching on here. We're just giving you kind of a primer on tax deductions and tax credits and how they might be able to work to your benefit when you're in a caregiving situation. And so that's really what I want you to walk away with from this discussion, and understand how dependents can work for you, and how a qualifying relative can end up being a significant tax benefit for you and your family in these situations. And at this point, I guess I will open it up to questions.
So Sandy's wondering, mom gets $27,000 Social Security a year. Is she required to file taxes, no other income, and she has Alzheimer's?
I would, you know, no, she would be under the threshold. With Social Security, there's a, you know, a modified adjusted gross income calculation that you have to go through. If $27,000 is her only income and it's from Social Security, then she doesn't have to file a tax return. Unless she's got some withholding, of course, and she wants to get that back. But she's not going to owe any taxes. And if she hasn't had any withholding, then there's no reason to file a tax return.
All right, Sandy said, much thanks.
Mm-hmm.
I see that Jean sent a question by email. It says, if mom is elderly and collecting Social Security, but paying $700 a month in long-term care, is the long-term care deductible?
Well, probably it's she's going to be in a non-taxable situation. So there's no reason to really even have the deduction. It would be deductible if she has other income to offset against it. But yeah, how much is she receiving in Social Security?
Let me see.
What was, in the early part of the question?
In the beginning part of the question, it just says she's collecting Social Security but paying $700 a month for the long-term care. So I'll give her 1 second to see if she'll respond back. Only because she's attending by phone.
Okay. But yeah, generally up to like 30,000 for a person single. If Social Security is the only thing you're getting, you don't have to file a tax return. And it's, you know, for a married couple, it's up to about 38,000 or so, where you would have to file a tax return. But like I say, if you're having withholding, you want to get that withholding back, then you have to file a tax return.
I have another question, if you can handle that while we're waiting.
Sure.
You had mentioned about claiming deductions, and you mentioned a support test. Can you clarify what that means?
Yeah, a support test is generally 50%. If you want to claim someone as a dependent, you're going to have to provide 50% of their support. Now, in those situations, when somebody's getting Social Security, and most everybody is getting Social Security, it really means that what you're providing, you can fit in. If you're providing housing to this person, if they're living with you, you can figure out what a normal rent would be. And if you're providing board, you can figure out, what you're spending on meals for the person. And if you've got other expenses that you're outlaying, you can add those all up. And basically, when you add those all up, they've got to be more than they're getting in Social Security. So in other words, their Social Security is providing less than 50% of their support. You're providing more than 50% of their support. That is that's the dependency test. That's the support test for someone to be your dependent. If you're providing 50%, then that's great. Now, if they're making more than $4,400, you can't claim them as a dependent for tax credits or take their insurance on the front part of the return, but you can claim their medical expenses on your tax return, which can be significant.
All right, thank you. And my next question, if Morgan doesn't have one yet.
I do. This is just a follow-up to Jean's question. Do you mind if I
Sure.
ask this? Okay. She said she's not sure about how much. I think the initial question was, give me one second. So the initial question was, if mom is elderly and collecting Social Security, but paying $700 a month in long-term care, is a long-term care deductible? And then her follow-up was not sure, collecting substantial amount because she's a widow and collecting the husband's Social Security, but income from investments.
Okay. Well, and those situations we run into a lot because, the surviving spouse gets the higher Social Security. And so she could be getting, 30, to 45,000. It's kind of rare, but could be receiving that much in Social Security. And in that instance, I would definitely take a look at all of her medical expenses, and see, start counting up, $700 a month for long-term care. That's $8,400 there. Chances are that if you put everything together, she's probably got some other significant medical expenses. It might be worth your while, but if she's single, the standard deduction for a single person is $12,950 this year. It goes to $13,850 next year. So the $8,400 would have to go through those two tests that I was talking about. First, it would only be that which is above 7.5% of her AGI. All right. And then, so it may not be worth her while to count all this up, because the standard deduction will take care of most of her tax bill. I have to look at the exact situation, but my guess is the taxes are going to be very little in that situation, and maybe a small amount of withholding can cover her. But if you've got substantial Social Security, you pretty much don't have to worry about Maryland taxes anymore, with the changes that came into law this year. Because you're not, you don't pay any Maryland tax on Social Security, and pension income exemptions have gone up as well for the state. So you know, it's retirees are going to have smaller tax bills from the state this year, and I've seen that so far in the returns that I've filed. But yeah, unless we have, you know, exact numbers, because we're dancing around the threshold. You know, if somebody's making $40,000 in Social Security and their only expenses are $800, you know, $700 or $800 in long-term care, chances are they might have a small tax bill. But my instincts would tell me in that situation, there's probably going to be little or no tax bill. Someone, you know, I'd have to take a look at the circumstances. Sorry to have to give you that answer, but that's frankly the only real answer I can give you.
The question I've received on the live stream is, someone has a joint account with their mother who will likely require assisted living using Medicaid. Do you see any concerns here regarding qualifying for Medicaid?
Well, yeah, that is a very complex situation that we would have to know a whole lot. You know, is the, you know, having a joint account? Yeah, is there $2 million in the joint account, or is there $100,000, or is there $50,000? You know, I would say though, because things are in joint name, there are situations, you know, where Medicaid planning can be very valuable. And I will just, you know, we're just touching on the subject right now, but you know, there are investment vehicles called Medicaid compliant annuities where you might be able to put this money, whatever they have, under certain guidelines, and get it out of a Medicaid qualification process, in which case they might qualify for Medicaid. But this is a complex area where you're going to need to contact either a Medicaid planning specialist, or as most of them are, as most elder law attorneys are, they are Medicaid planning specialists, or they have someone on the staff that is a Medicaid planning specialist. And that's really where you need to go. You know, the answers, unfortunately, to, you know, to specific situations, in most cases are going, you know, when I answer them, I'm going to tell you that, yeah, this is when you need to go see a professional and somebody to look at and marshal all the facts and get some advice as to how you should proceed. And if you can't afford to see somebody like that, then you may want to contact someone involved in social services that can see if they can get you some help in this area without exorbitant fees.
I have a question next from Mark Kim, and it says, for the $4,400 income limit, does Social Security disability offset this?
Social Security disability does not count on that $4,400. Social Security retirement benefits do. Okay, so yeah, if they're on SSI, what we call SSI, that is not included in the $4,400 calculation.
Okay, the next question is from LJRVO. It says, I am sorry for joining late because of technical difficulties. My question is, I moved here to live with and care for my sister who has dementia. I have delayed getting help. I've delayed getting help in since she is opposed to it. At times, she has paid for my medications. I am also behind in filing her taxes, and unfortunately, her tax account has been patient with me. What suggestions do you have for me? I heard you say you get an agency in for, what is this? CSARE.
For what?
I'm not sure if that was a typo. It just says, I heard you say get an agency in for, maybe she just meant, or this person meant care.
Yeah, if they're in a situation now, it sounds like he's moved to the area. You know, I can't tell from his question whether she's a dependent of him or he's a dependent of her, from what they've stated so far. But the person that needs care, and if they need somebody, if you need to hire somebody as a professional caregiver, then I recommend, for administrative convenience, that you hire somebody from an agent, somebody that's a licensed caregiver, working for an organization that will bill you periodically, and you either issue them a 1099 if they want you to, or if they're incorporated, you do not have to issue them a 1099. You can just use the payment of their bills as documentation for cost of long-term care. Like I say, if you're getting into a situation where you're going to be paying someone, and that person that you're paying to do caregiving is really only doing the caregiving for one person, and you control when that caregiving is made, then you're in a situation where you control somebody, and the IRS looks at that as an employer-employee relationship. And so they are going to prefer to have a W-2, which I find administratively burdensome. But I can, I can understand situations where you have to go that way. But to file quarterly withholding and quarterly Maryland unemployment insurance forms, plus to do the Schedule H, which becomes part of your 1040 at the end of the year. Plus, you have to issue the W-2 to the person, go through that administrative requirement. I would say probably to stay away from it unless you absolutely have to.
A follow-up from LJRVO. It says, sorry, give me 1 second. I'm trying to scroll down. Fortunately, sorry, typo. Home health care agency clarification. That's for confirming the agency issue.
No, I'm not sure what he's asking there, but my advice remains the same. If you're going to hire a home care provider, I would do it somebody that's in the business, certified in the business, and is incorporated and can bill you, and you merely have to pay the bills and add up the bills and put them on your tax return.
Okay, I think that there's more clarification. It says that my sister also has long-term in-home healthcare insurance.
Okay, and if that insurance is going to pay for the caregiver, then that's fine. Now, if you're You know, the way these things usually work, though, is that they're going to give you the money, and then you're going to turn around and pay the caregiver. Okay, and so you still are going to be confronted with the W-2 versus 1099 versus an incorporated caregiver situation. And what I'm saying is the most administratively convenient way to handle that is to hire an incorporated caregiver that's going to bill you, and then all you have to do for your tax situation then is to add up the bills that you pay less the reimbursement. Now, you cannot deduct whatever the insurance company is paying. So that is
The person said, could I get paid?
well, with with a lot of these home health care policies, you can get paid, and then they may be issuing you a 1099. If that's where you're headed with this line of questioning is, the home health agencies don't require that you go out and hire a licensed professional in some instances. You have to have them to do certain things, but just to assist with the activities of daily living, you can hire a private citizen, and that person can be paid by the insurance company, and that insurance company, I believe, will probably issue you a 1099 NEC.
Okay, so the question from Jean is, if a wife is providing full-time care for a disabled husband, and this is very hard on her, both elderly in their 70s, is there any provision for in-home care from an outside caregiver as a respite a day or two a week so that the wife does not get worn out and the task of caregiving cause her to need care herself?
Well, yeah, respite care, this is, they're going to be filing a joint tax return, and respite care for the caregiver is a deductible long-term care expense. So, adult daycare is a legitimate medical deduction, but respite care for a caregiver in a joint situation like that you described, that should be eligible as a medical deduction.
Kathleen, I don't know if you said something, you're still muted.
Sorry about that. And is anyone else, Morgan, anyone that you can see might be typing or?
Nope, nothing on the
Pretty much
chat
it.
end. Nope.
Okay. Well, then we will wrap it up for tonight. You could always, John, did you have an email that folks could write to you, or did you want them to go through us?
Yeah, you can email me directly if you'd like. It's a pretty easy email. It's John, my first name, at jlpie.com. My first initial, middle initial, and last name.com.
Morgan, if you want to put that in the chat, as well as you can reach us at caregivers at baltimorecountymd.gov, G-O-V, if you have further questions about the Caregivers program, or would rather go through us and then we can talk to John, we can do that as well.
Okay.
So well, thank you so much, John. Appreciate you very much for being on tonight and for your presentation. And I want to let everyone know they can join us again on March 15th at 6:30 for decluttering and organizing with senior transitions. So if you all are interested in that, please email us again at caregivers@baltimore County, Maryland, MD.gov, or you can call us